Good morning, everyone. Welcome back to our channel. This is Blue League Markets, and in today's lesson, I just want to do a top-down analysis because a lot of people have been requesting a video saying that I should do a video on how to do a top-down analysis. If you're new to this channel, please don't forget to like, subscribe, and comment. Just leave us a comment so we can know what you're struggling with and we can assist. We'll make sure that we answer every comment that we get on this video and any other video. And please don't forget to go and watch the other videos and share our work so we can be motivated to do more videos. As I said, on this video, I'll be doing top-down analysis and I'll be doing Nasdaq, US 100, and I'll be starting from 1 day, hopefully to 4 hour or 1 hour, depending on how far I go with this analysis. So, a lot of people usually ask me a question like, when you do a top-down analysis, where do you usually start? So, I usually start on the daily, just to get a day overview, just to get an overview on what's going on the daily chart. Then when I map my chart, what I do firstly is I will mark my highest point, which is my swing high. Then after that, I'll mark my swing low. So that's the first thing I do, mark my swing high and swing low. So I denote it using a dot. So that's my swing high and swing low. Then after, I'll just try to check what has been going on. So I'll mark the previous data so I can know whether we're having an uptrend or a downtrend and what the market is currently doing. So my past market price action is going to give me my future price action. So after marking my swing high and swing low, what I do is I want to understand what happened for me to have this swing high and this swing low. Where was my break of structure? Where was my inducement? And where was my liquidity? And where was my order block, right? So, meaning I'll just go back a little bit and just check what happened in the price. So, from this, I can clearly see that, okay, the market broke structure there. So, that's where I had my break of structure, which allowed me to have that swing high, right? So, I'll just note that break of structure. So, that means we had a break of structure to the up. So BOS up. So we had a break of structure there. Then after that break of structure, we printed a swing high there, and the price action went down, or the price went down to collect orders. Now I want to understand, when the price broke structure there, where was my inducement? As you can see that my first inducement was here. So this was my first inducement. Now remember, inducement happens when the market has a pullback, right? So my first pullback was there. So this was my first inducement. But my second pullback was here. So this was my second inducement when the price decided to um break structure then. So before it broke structure, it had this first pullback, then it had that second pullback, right? So after having that second pullback, I cannot say this is a pullback because it didn't go above that price. It didn't go above my swing high, meaning it was just collecting orders here. It was just taking orders from this order block. So it's not inducement. I cannot say this is an inducement. The price was just taking orders there, right? So they were having a pullback to come and collect orders from the down, from an order block which is around the spot. So that was my inducement. So what I also realized is that, let me delete this. What I also realized is that the market, since it printed an inducement there, that means the first inducement has changed to now what we call engineered liquidity. Now remember, the market can bring two things. It can bring you an inducement and it can bring you engineered liquidity. So firstly, the first pullback, it's what we call an inducement. But if the market brings another pullback, that means the market is no longer having an inducement, but it has two things. It has an inducement and engineered liquidity. Let me just write draw it here so you can understand. So the market can have a first pullback, it will go there, and it will have a second pullback until it ultimately breaks structure. Let's say it does something like that. So just know that the first pullback, okay, this is supposed to be here. That's before the market broke structure, right? So just know that all of this is what we call internal structure, and the first pullback is what we call engineered liquidity, and the second pullback is what we call inducement. Let me not say the second pullback, let me just say the most recent pullback, which in our case before the market broke structure, is this one. It's what we call our inducement. But the first pullback, which is the pullback which happens before the market proceeds to going up or down, it's what we call engineered liquidity. And the market becomes more accurate when it gives you engineered liquidity. So when the market gives you engineered liquidity, just know that it has to come and break that engineered liquidity there before it proceeds up. So if, for instance, we had an order block here, for example, this order block, just know that the market will not collect orders on this order block because now it has engineered liquidity. It has to collect orders below our engineered liquidity. Then after that, we check where the market collected orders. As you can see that we have this order block. We cannot really say this is an order block because, okay, it broke at the lowest point of that candle, but it didn't go beyond that candle. So we'll take this whole candle as an order block, because what happens is these two candles are what we call internal candles, right? I have a video explaining that on my private group. For those who want to join the private mentorship, they can just join using the link, which I'll leave, the WhatsApp link, which I'll leave up below. Then after that, you can just text one of our mentors. Going back to what I was saying, so the market took orders there. So from this, I can have an understanding that on my daily perspective, the market is moving between this point and this point, right? Our swing high and our swing low. So when the market breaks this point, when the market breaks this point, we'll be looking for, so the market will be doing something like this, and when it breaks that point, we'll have a break of structure and we'll anticipate for the market to come take orders, maybe in this order block, then continue going up, do something like this, leaves us with liquidity and inducement, then continue having something like that. So this is the importance of going to the the higher time frame, because now it gives you a perspective on what to expect from the market in the next coming days or weeks. But then if the market then decides to come and break this lower swing low, that means then we'll anticipate the market. Let's say the market decides to go down and it breaks this lowest point, it breaks this what you call this swing low, then we'll anticipate the market to then proceed to go and collect orders, maybe in that extreme order block, right? So we'll anticipate something like this. So what I'm trying to explain is that going back to your higher time frame gives you a perspective on what to expect from the market in the coming weeks or days, so that you don't just trade blindly, so right. So this is what we understand from the market. We understand that it broke our inducement and it broke our engineered liquidity. It collected orders there, and if you wanted to take this trade, you could have went to a lower time frame, as far as the 1 minute 1 minute order block, then you could have taken that trade. And if you go to 1 minute, you could have had a very small stop loss. Then the take profit is obviously your swing high. So I'm sure some of the guys have taken this trade, and this is what it looks like as it stands, right? But today I'm not going to go to the lower time frame and explain how you take this trade. I just want you to understand how we do a top-down analysis. So now we understand our what we call, we understand our daily perspective that the market is having an uptrend, but it's going to gradually go up and then it's going to have a huge drop. Now, when it has that drop, we're going to understand that the market is going back to collect orders, right? Now that's clear. We understand what's going on our 4 hour chart. Now, one thing I want to explain before I proceed to the 4 hour chart is what we call SMT. SMT is smart money trap, right? As you can see that when the market broke structure there, other people could have said that there was a break of structure there and this order block, because if you can check this order block, it has left some imbalance there. So if you don't understand how to mark your swing high and your swing low, you can easily get fooled by what we call SMT, because now you could have said that's your swing low, that's your swing high, and when the market broke structure, no, you could have said that's your swing low and that's your swing high, and when the market broke structure there, you could have said that this order block it's important and that it has to take orders there and proceed up. That's why certain people, they say smart money doesn't work, because they get fooled and they take orders in what we call SMT, which is your fake order block, which is your smart money trap. I'll explain this more when I go to the 4 hour chart. But when you're trading smart money, just know that before the market takes out your inducement, just know that it hasn't completed its pullback, right? So the market has to come and take inducement first before it can collect orders in any order block. Now remember, we have only two accurate order block or two high probability order block. We have an order block when the market has taken your inducement, and we have an order block when your market has taken your engineered liquidity. Besides that, any other liquidity, any other order block, per se, it's what we call smart money trap. I hope that's clear and I hope you understand that, but I'll keep explaining. So, after understanding our daily perspective, we go to our 4 hour chart. So, we move from our day to our 4 hour chart, right? So, these two lines are just going to be guideline on which boundaries are we trading under, right? Now, I just want to explain more on the SMT. As you can see that this SMT was my daily SMT, right? My day SMT. So you could have taken a trade there thinking that the market is broken structure. But now remember, there was no inducement which was taken. That's why the market gave a false move. It promised people that it's going up, then it went down and it took almost all the stop losses which were there, right? So when we go to our 4 hour chart, what we need to do is we need to adjust our lines or adjust our swing high and swing lows. So let me adjust that so that they can sit accurately where they need it. Let me just delete that line because I don't like having lines in my chart. It just feels like I'm having support and resistance, and I don't trade such, right? So after you have done with your day, you need to go to your 4 hour chart and you need to also understand the story, right? Where do you start this? You start this by going to where it collected orders, this order block. This is where it collected orders. Now remember that after something has collected orders, it needs to have a choke. Now let's say you had an order block. It doesn't matter which time frame it is. Let's say your 1 minute, your 5 minutes, it doesn't matter. When the market approaches your order block, it's going to keep on having pullback. After it touches your order block, it's going to proceed, it's going to leave you with an inducement, then it's going to proceed up and it's going to break structure. Well, it's going to have what we call a change of structure. Then it's going to proceed and break this inducement, then it's going to collect orders, then proceed up, right? So it's going to have something like this. It's not going to collect orders here, it's going to collect orders somewhere here, because now remember, this is the higher time frame, right? So you're going to anticipate something like that. So you're going to anticipate a change of structure there. So that's your chalk. This is where the market is having a flip. So you're going to anticipate a change of structure there. Then afterwards, you're going to anticipate the market to come and take orders there, right? After taking inducement, after breaking your inducement. So this is what we anticipate the market to be doing after it has taken orders in our daily order block, right? So that's what we're going to want to see on our 4-hour chart. As you can see that the market um created something like this. It broke structure where? It broke structure here. So this is where we had our break of structure, and in this case we call it a change of structure. So our change of structure happened there, then the market went up. Then when the market went up, we do the same procedure as our day. We mark our swing high and our swing low. As you can see that our swing low has already been marked. It's our daily swing low. It changes to our 4-hour swing low, because that's where the market changed character, right? That's where the market took orders and it proceeded up. Now we need to understand, after the market has printed the swing high, right? We need to check where is our what? Where is our inducement, right? That's what we need to check. Can we say this is an inducement? We cannot say this is an inducement, because for me this is a single, the market just created a single leg going up. It turned there and it did something like this. Why am I saying that? I explained this in in one of my videos in the private mentorship. We cannot say we cannot say that the market had a, okay, excuse me, let me put that back. We cannot say that the market had a pullback there, because all this is what we call internal structure. This candle did not break that a candle's high. This candle did not break that candle's high, and they also did not break the both the high and the low for this candle. That means this is not a pullback. The only pullback we had, which is a proper pullback, is this pullback right here, right? We can also say that this is a pullback, right? Yes, we can say that that is a pullback, because if you can check, this candle broke this low, and it also broke a high for this candle. So we had, and our first inducement was here. So this is our first inducement. This is where we had our first pullback, right? Then the market proceeded going up and it created another pullback there. So our final inducement was there. Now remember guys, inducement is inducement is that final pullback, right? Before the market broke structure. So in fact, we can say this is our pullback before the market broke structure, because the market had a change of character there. Then it went down and it broke that high. So yes, we can say this is our inducement, because that high was broken, right? But now you should understand, when that high was broken, this is not break of structure. Why am I saying that? The market has not yet returned and broken that inducement. After the market has broken that inducement, we can then say that it's break of structure. So this is also part of what I call a single leg. This is a single leg. If the market did break the structure, then after that it proceeded to break this inducement, then continued going up. We could have said that a break of structure there, right? Now because that the inducement was not taken, it was not break of structure. So this is a false break of structure. If you thought this is a break of structure and taking a trade there, you could have been stopped out there. That's what we call SMT, right? So the market had an inducement there, and remember that the inducement here has now changed to what we call engineered liquidity. And now this engineered liquidity becomes powerful, because now it has what we call, we have what we call a double bottom there, because this candle turned exactly there, right? So that's engineered liquidity. Then the market turned from this order block. So the market had an, so that's a high probability order block. The market turned there, right? So now after the market turned there, it proceeded to go up and what happened, it broke structure there. So now we have a perfect break of structure because our inducement was taken. Now guys, I keep on repeating this, the only way we can have a break of structure is if our inducement was taken, orders were taken in an order block, and engineered liquidity was taken, right? Because remember, this is a game, guys. It's liquidity game. They need to take stop losses in order for them to proceed to go to another direction. So don't be part of liquidity. You should understand how liquidity works. Now, since we have that as our swing high, that means we have to mark this as our swing low. Now remember guys that this swing low can only be valid after the break of structure has happened, right? Then we continue. Now this swing low has to be supported by our swing high. Where is our swing high? This is our swing high. So okay, let me delete that. So now we on our 4-hour chart and we understand where the market is going now. So we can set our limits. So we know that the market is between it is moving between this um 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 swing high and swing low, and we can check which order block makes sense. But before we do that, we need to check this leg and we need to check for our inducement, our engineered liquidity, and we need to check for an order block. As you can see guys, that this we cannot say is any pullback. This is a single leg. The low of this candle was taken there and the high was taken there, so we can say that this is our engineered liquidity, or we can say this is our we firstly say this is our first inducement. Then we check if the market has left any other inducement, right? Then as you can see that the market has left an inducement there because that's a perfect pullback. So the market has left inducement there, so that means we have engineered liquidity here, right? Excuse me. We have engineered liquidity there. But if you want to say that this is engineered liquidity, you need to also go down and check if you have any order block that can be mitigated. As you can see guys, that there is no order block which can be mitigated. This order block has already been mitigated, this order block has already been mitigated, those are inside candle. This order block has already been mitigated, this candle has already been mitigated. The only unmitigated order block is this one. I have a video on my paid mentorship explaining mitigated and unmitigated order block, high probability order blocks and low probability order blocks. As you can see that the market has broken inducement and it has collected orders. You could have taken a trade there to go up, so that's another trade. We could have had a trade there, there and there. We could have had 3 trades going up, right? So since the market has taken orders, it means that we will wait for the market to break to continue going up, and immediately it breaks this line, that means we're going to have a break of structure, and we're going to denote this as our swing low, and we're going to work within this boundary, meaning we're going to wait for the market to come and take structure, then continue going up. It's still the same thing guys, it's just repetitions, repetitions, repetitions. What you need to see the market doing is you need to see the market breaking structure. Let's say the market is going up, it will break structure, and before it breaks structure, it would have left you with an inducement. So the market has broken structure then. Okay, let me redraw that. So it's the same thing guys, we just need to see the market doing the same things over and over and over. So the market has broken structure there, so we have a break of structure there, break of structure to the up, and we check if the market has given us any inducement as it was doing that. As you can see that it gives us our first inducement, then that inducement moved from that point to that point. So that was our the most recent inducement. Now guys, before this inducement is being taken out, if the market does not come and take out this inducement, let's say the market does something like this and continues going up, guys, this is not break of structure. You cannot say this is break of structure, because immediately you say that line is break of structure and you look for an order block here, the market will come and it will give you a small reaction here. Immediately it gives you that small reaction, it's just going to take you out, because the first thing the market has to do before it proceeds to go up, it needs to take out the inducement, right? So don't be part of smart money trap. You should understand how smart money works and you'll be able to take trades. So after moving from your 4-hour chart, you can then go to your 1-hour chart and you can continue doing the same things as I've mentioned on the other time frames. So you just adjust your swing low, you fix your swing low. Now remember that when the market came in and touched on the order block, you need to see the market changing structure, right? Then after you need to see the market having a change of structure, we can say the market changed structure there, because that was the last pullback. So that's where we had a chalk, because this is a single leg. The market had a chalk there. Then afterwards, you need to check your inducement. This is inducement, guys. I'm repeating the same thing over and over. Forex is easy, guys, because you're just repeating the same things over and over. You just need to know how to understand them. Then afterwards, now remember that when it took when it takes out that inducement, you can take a trade. But before you do that, you should not be part of smart money trap. You need to understand if it's a complete pullback or it's not a complete pullback. How do you do that? You use your fib retracement. You take it from your swing low to the swing high. As you can see, that order block was not above below the 50% zone, meaning the market was not having a full pullback there, right? So that means this order block was what we call SMT. So that was smart money trap. As you can see that the market then also proceeded to give us an engineered liquidity there, right? So that means the only correct order block here had to be below the engineered liquidity. But as you can see here, if you go to lower time frame, you'll be able to get the order block. It's going to be on this week, the week of that order block. As you can see that the market has came there and it has perfectly touched that order block, and is going to proceed to go up. I didn't want to take any trades here on this lesson, guys. I just wanted you guys to understand how you do a top-down analysis. You repeat the same steps, you set your boundaries, you understand what your daily perspective is. Then afterwards, you go to your 4-hour, you do the same thing, you understand what your 4-hour perspective is. Then afterwards, you proceed to your 1-hour, you understand what your 1-hour perspective. So your 4 hours is going to guide your daily chart is going to guide your 4-hour chart, and your 4-hour chart is going to guide your 1-hour chart, and your 1-hour chart is going to guide your 15 minutes chart. Now remember, guys, that forex works in what I call it works in, I don't know what to call this, four. It works with the number 4. That's how I usually check my charts, right? The number 4. Let me explain this. The number 4, right? When you start on your daily time frame, so you go to your daily time frame, 1 day, then you proceed to your 4-hour chart, then you say 4 divide by 4, it gives you 1, which is your 1-hour chart. And as you know, guys, that so in order to get the next chart from your 4-hour, you say 4-hour divide by 4 divided by 4 to take you to the next chart. Then from your 1 hour, to get to the next chart, you say You say 60 minutes divided, because 1 hour is 60 minutes, divided by 4, it will give you 15 minutes. So the next chart you need to go to is 15 minutes. Then after the 15 minutes chart, for you to take trades, you need to go to your 1 minute. That's where you will take what I call sniper trades. I didn't want to explain sniper trades on this chart because it was just a top-down analysis. I didn't want to make this video long, and I can see that now it's getting too long. I hope that you guys understood everything I explained in this video, and if you didn't, please don't forget to leave me a comment below, and I'll definitely get back to you. This is Blue League signing out.